So in today's video, I'm going to explain a very common piece of market jargon plastered all over investment websites and analyst reports, and that's beta. Now, to give you an example, Glaxo has a beta, whatever that is, of 0.5. Apple has a beta of 1, and Rio Tinto, the mining stock, has a beta of nearly 2, rounded there slightly. So what are these numbers? When someone throws that at you, what's that supposed to tell you about these individual stocks? So today's video, what is beta? How can you use it? And what are some of the most fundamental drawbacks? Okay, for university graduates out there, this is not a mathematics module, so I'll be mentioning grand terms like regression analysis as we go along, but I'll save explaining that to another video altogether. Okay, so what is beta? In a nutshell, these numbers represent, or are supposed to represent, a risk. Beta, that's B-E-T-A, or that symbol, for Greek experts, is supposed to represent the risk of these individual securities. What does that mean? How do you measure riskiness? It means how sensitive are these stocks? How volatile are these stocks? And beta specifically says, what do these stocks do when benchmarked against the wider market of stocks? Do they move with the market? Do they move less than the market, low volatility, or do they move more than the market? And the market is often defined as, say, the S&P 500, if you're looking at the US, or a version of the FTSE. The 100 is a bit narrower, but you could take, for example, the FTSE All-Share. All right. So beta is a measure of how volatile a particular stock might be when measured against the rest of the market. Okay. Now the technique is called regression analysis. That's one of those terms that might have caused a few people to give up and have a cup of tea, but don't panic. Regression analysis is the way you get to these numbers for particular stocks. And by the way, this video I'm going to talk about stocks, but actually this can be applied to whole portfolios as well. But stock betas, the idea is simply this. Now this is a very quick and dirty guide to regression analysis, but essentially all it does to come up with a beta is this. All right, if that's time, if I was to plot, I'll make up the line, the S&P 500, that's the main index in the US market, okay, and let's say over a couple of years, so we've got year 1, year 2, it does something like this. All right, the market, this is just the convention, has a beta of 1. Okay, now you might have noticed when I had my stocks up that GlaxoSmithKline, the big pharmaceutical, had a beta of just 0.5. Apple, technology company, had a beta of just about 1, and Rio Tinto had a beta of twice the market. So what's going on there? What are they doing? How are we measuring this? Well, in a nutshell, this is regression analysis, really is distilled right down without any numbers. If you have a stock that pretty much tracks the market, give or take, then it also has a beta of 1, or near enough 1. So stocks that pretty much do what the market does, rise when it rises, fall when it falls, are given betas of around 1. Maybe not exactly 1, could be 0.96 or 1.05, but about 1. Okay? If, on the other hand, you have a stock that does this, sort of exaggerates what the market's doing, okay, Loch Ness Monster style, that would have a much higher beta, well over 1. All right, mining stocks tend to be quite volatile. Rio Tinto has a beta of 2. All right, so volatile stocks, and regression analysis, by the way, just calculates over a time period sort of what's happening to the distance between the stock line and the market line, if you like, but I won't go into the mathematics here. It's a technique you can use to consolidate all that information about stock prices against the market into one number. So high beta stocks move a lot more than the market. They're more volatile, okay? Think mining stocks and banks, for example. And you can have beta of less than 1. Regression analysis could spit out a beta of less than 1, and that would be a stock that actually is less volatile than the market. Okay, so it's actually not moving around even as much as the market. And that would be a beta of less than 1. All right, and for completeness, by the way, is it possible to have a negative beta? is it possible to have a stock, I won't mess up my diagram any further, that pretty much does the opposite of what the market's doing? So the market's going up, it's going down. Well, there are one or two inverse exchange traded fund type products around. There are one or two stocks around that do pretty much that. So you can even have a negative beta, right? And that means that the stock's returns are sort of the opposite of the market, if you like. Okay, so you have this number, beta. All right, it can be greater than 1, tends to suggest a volatile stocks that move around more than the market. Around 1, a stock that pretty much goes with the market, or almost is the market. And less than 1, less volatile. Okay, and if you're thinking of grouping stocks, now there's where my first slide makes a bit more sense, if you like. Mining stocks and banks tend to be highly volatile, stating the obvious really, but when you see on an analyst report, the Rio Tinto has a beta of 1.8. Okay, that's the number telling you you've got a stock that moves roughly 1.8 times the distance of the market. All right, so this is what it means. If you've got a beta of say 2, it means you have a stock that usually moves, looking at the past over say 2 years, using regression analysis, twice the distance of the market. What does that mean? So when the market rises 10%, it goes up 20%, beta of 2. When the market falls 10%, it drops 20%. Yeah? Whereas an Apple, that I mentioned, is moving with the market. So an Apple type stock with a beta of around 1, if the market goes up 10%, that stock will tend to rise 10%. So the market goes down 10%, it'll tend to fall 10%. And the low beta stocks, now I had GSK, GlaxoSmithKline up here, beta of less than 1. I said it had a beta of about a half, actually, if you remember that. That tends to suggest that if the market rises 10%, it'll just go up 5%, half the distance. If the market falls 10%, it'll tend to go down 5%, okay? So beta is this kind of rough and ready measure of the sensitivity of a stock relative to the rest of the market. How risky is it? Now, how can you use that? Is that useful? Does that help quantifying that? Well, it can do. Here are 2 or 3 uses. Number 1, some people use it to predict a stock's returns relative to the market. So there are people out there who will say, well, Tim, if I have a stock with a beta of 1.2 and the S&P 500, that's the US index, goes up 10%, if that's what I think is going to happen, then I could expect whatever this stock is to go up by 12%, 1.2 times 10%. So you can sort of use it, and people do sometimes use it in that way, as a predictive tool, okay? Secondly, here's a very, very blunt strategy. When the market's rising, some people would say you want high beta stocks because they're the ones that are going to overshoot. They're the ones that are really going to pay back. When the market's falling, on the other hand, you want low beta stocks. You want the ones that are dragging the market, not falling as fast, okay? Translate that into investment speak. There is no argument that says when the market's rising, you want to buy cyclical stocks, the miners, the banks. When the market's falling, you want to be in more defensive areas. Maybe that's pharmaceuticals, for example, or utility companies, okay? Tend to have lower betas. And the third use is diversification. That's a video in its own right, but you do take a risk. If your portfolio is packed with high beta stocks, you are going to suffer when the market falls off a cliff because they're all going to plunge like lemmings, okay? So a diversifier would say, well, I don't want a portfolio stuffed full of high beta stocks. I kind of need to balance it out a bit, okay? So it takes you into kind of the theory of diversification, which I'll cover in another video. Now, it all sounds brilliant so far, so I can use it to predict how stocks will perform, I can use it to spread my risk via diversification, I can use it to work out whether I need to be in cyclical stocks or defensive stocks and capitalize on market movements. Sounds too good to be true, and that's because it is. All right? You have to be careful with beta. Here are just 2 or 3 big criticisms of beta as a predictive tool as to what stocks will do next. Number 1, it's historic. You look backwards to calculate it. Don't worry about how regression analysis works, how I got that sensitivity number of 0.51 or 2, but the point is you're looking backwards. Okay? You're saying that, well, over the last 2 years, GlaxoSmithKline has appeared to behave this way, so I'm going to use that to predict what it'll do next, and that's always dangerous. The past isn't necessarily a guide to the future. Okay? Secondly, there are different ways to calculate it. I mean, why did I look on my graph at 2 years of historic data for the shares I was drawing? Why not 5? Why not 10? Okay? And the answer is, there is no right answer. Should I look at longer than 2 years? Should I go back further? And opinion divides on that subject. And that's why, if you look at betas from different suppliers of market data, they won't always be the same. good reliable suppliers include like Reuters, Bloomberg and so on, but you won't always find that the beta number agrees if you look at two different sites for one stock. Okay? And thirdly, beta only looks at one thing. It's the stock's risk relative to what the rest of the market is doing. Okay, it doesn't really tell you much about the sector, for example. Isn't it more relevant to know what Rio Tinto is doing against other miners? Because maybe there are miner-specific issues, new legislation or permits or licensing issues out there that need to be factored in, okay, to make the number more useful. So, people look at beta and think, brilliant, it's this kind of magic number. And it's an easy number. It's a small number, like 2, so I can use it to predict that my stock will give me twice the return of the market, and they forget that actually that very simple looking number is the result of a lot of number crunching, a lot of assumptions, and not all of those assumptions are strictly speaking valid. Okay, so by all means, take a look at a stock's beta. By all means, use it as a rough and ready guide to how volatile the stock might be. But as with all single numbers that look like they offer that kind of holy grail of, great, this is the number I can rely on, don't do it. To download this free video to your favourite mobile device, find us on iTunes by searching for MoneyWeek. And the entire video archive is also available free. Just visit MoneyWeek.com.